Welcome to Real Money Talks. Real strategies from the moneymakers and the world changers that you can use to make millions, keep those millions, multiply your wealth, and build your team. Here's your host, author of 5 New York Times bestsellers, money expert on Dr. Phil, CNN, CNBC, The Street TV, Fox News, and The View, Loral Langemeier.
Hey everyone, welcome to today's Market Awareness webinar update. Very happy to have you here. We have a very special guest, member of the community, Weldon Wulstein, will be on talking to Loral. Before we get started here, before we push live to all of our social channels, want to do a quick rundown on how today's call will be handled. If you're joining us via Zoom or any of the social channels, let us know what your number one tax question is. We're going to be having those conversations today. Part of our larger conversation about getting our financial houses in order in terms of making sure we end the year strong and start the new year off right. Everything going on current events wise is very important. You realize that the end of the year is sooner than you think. So with everyone, would love to, there we go. We have people hopping on now, going live to Facebook and Twitter. So I will go ahead and put it over to you, Loral. How are you doing today, ma'am?
Awesome. Thank you. And again, welcome all of you. We are wrapping up, as you know, our virtual meetup and marketplace. So last Thursday, Friday, actually Wednesday, Thursday, Friday, we had, I think, just over 100 people doing our marketplace. And we don't have the results, the audit. What had kind of happened? Did they just not bring their auditing, right? So it's interesting we have Weldon on because talk about our auditing. They just don't want to give their contracts in order.
Actually, no, there were so many sales, they had trouble getting all the sales receipts. That was what happened for 2 of the people. So we know who the unofficial winners are. Once we get them audited, we will let you all know. But so far, it's looking like our first place seller sold $7,500. Our second place seller sold $3,500, and our third place was just close to $1,000. So it was a very productive group in terms of the number of sales.
Nope, that was good. And it was kind of a slow start on Thursday, Friday. So I think you finished strong as a group. And again, want to acknowledge those who have jumped into some sort of advanced coaching program, especially those in VIP and Big Table. And you'll be welcomed by Jordan and Damon and brought into the community. So our broadcast starting last week, we have like a 7-week run to the election, which is on November 3rd. We will be broadcasting. So we want to make sure you do your financial infrastructure, we're calling it, and getting your house in order. And also just acknowledging that really by the beginning of November, if your house isn't in order, the chances of you getting stuff done with any of the agencies in this country, or probably any country, quite frankly, Canada's even, I should say, almost worse, just knowing that from my husband, on how many agencies are shut down and like getting incorporated, getting anything that you need from any of them. You probably need to get that done by the beginning of, again, November, no later than mid-November. And I brought an expert, good friend, my CPA, Weldon Wulstein, is with us today. And we're going to talk about taxes all day, your favorite subject. So what I love about it is, believe it or not, I think taxes and tax strategy is extremely creative. I know some people probably think that's odd. You must think it's creative, Weldon, or you wouldn't have got into this. But share with the group. And I have my chat up. I'm not seeing a lot of questions. Again, the question is, what is your number one tax question? So we want to hear from all of you. What's your number one tax question? So we can put that out to Weldon. And we'll talk through some of the dates. We'll talk through how I'd say we act, think, and make money the way the wealthy do. We pay tax different too. So with that, Weldon, welcome to our Tuesday broadcast.
Thank you. I'm glad to be here. Super excited.
So give a little background. Who are you? Why tax? People, I think, say, I think a lot of people think it's boring. I think it's extremely creative. It's probably the funnest part of it.
Yeah, I mean, people kind of ask why or how I got involved in taxes. And, it's ever since I've been a little kid, I've always liked puzzles. And so kind of the way I see it is each different tax strategy is kind of like a puzzle. Mm-hmm. You have to kind of look ahead and plan, but you can put that puzzle together, and putting it together, different pieces for different places for each custom person and each thing. So that sort of drove me to really get more involved in the tax strategies and the tax planning. Obviously, you have to prepare the tax returns, but really kind of got into the planning part of it and the strategy part of it, because that's where the fun stuff happens. Then your clients, or you're not telling them that they owe a couple $100,000 on April 15th when, scares the crap out of them. So going back, and especially this year, I mean, you really hit the nail on the head when you're saying you really need to plan this year. I know we've had some of these webinars previous, kind of always told everybody, you got to plan. I mean, this whole thing, you got to plan, you've got to plan. But this year, because, I mean, even trying to get any kind of information from the IRS, they're pretty much shut down. So they're not even, the only essential workers are working. Everybody's down at home or at their houses. They're not even collecting mail. I mean, they've got truckloads of mail that haven't been processed. So yeah, so there is a very distinct process. And I know, you've talked about, you've got to get your records in order, so that includes your bookkeeping, that includes your entity structures. I mean, you've got to do that. You've got to do that now. You can't wait until December 21st before you do that, because it's not going to happen. And I know a lot of people don't want to deal with the taxes, but unfortunately, they're not going to go away. Always have to deal with them. And I mean, you might as well just, instead of procrastinating, get it done, do it now. So then we can plan, and then it doesn't necessarily mean we have to file your returns, before April 15th. Typically kind of wait until the September and October to do that, but at least
I'm just going to explain that a little bit. A lot of people don't realize, they hear it. And of course, they go back to TurboTax, H&R Block, some, and even some accountants that just, don't want to work through the fall. Explain those date differences.
So basically, I mean, on a normal year, obviously 2020 was not a normal year, but on a normal year, your tax returns due April 15th. But for individuals, it's due March 15th for any kind of business that sends out a K-1. However, you have the option to extend those. So you can do an extension all the way up through September 15th for the entities and October 15th for the personal and individual.
Why do so many people still file in April, though, when we know you have that whole time? I'll just kind of lead with the assumption is most people are waiting for money back versus keeping it.
So I mean, there is a good reason why you would file in April, before April, is because you have paid the government. You've basically loaned money to the federal government for free. So everybody wants to get that refund back. And if you have a refund, I mean, it's obviously coming back, and you obviously can file it. You file it early. So there is the potential of filing it early. I mean, that's one of the reasons why. But if you're getting a refund back, let's think that process.
Yep.
So, and I mean, people get excited about this, saying, "Oh, I got $7,000 back, or I got $10,000 back." It's like, so you realize you took that opportunity and you gave the government that money. You physically gave it to them. They got to use it however they saw fit for 12 months, and they don't send you interest. They don't send you, I mean, even if you took that money and put it into a bank and a savings account, at least you're earning 0.1%. You're ahead of the game. I mean, forget about any other opportunity costs that you might have with that. But if you don't prescribe to planning and doing any kind of planning for this, then yeah, so you're kind of stuck. People can't typically afford to come up with $10,000. And so that's where it comes back to this whole thing where you have to get your stuff in order. And you should have it in order every quarter or every month. I mean, it needs to be done throughout the whole year. Now, we're coming to the point where it's like, you've got to get it done now. Otherwise, it's going to be too late. And you're going to be one of the ones, that have just given your money away to the federal government.
So, well, let's jump into some of these questions. So, somebody from the 100K group, right? The folks that are working on making 100K in income. When or why would you move away from an LLC sole prop to an S Corp or a C Corp?
Instantly.
Okay. So explain why.
There's several reasons. One, if you put a LLC, so an LLC have the option to do a disregarded entity, so that would be where it'd be considered a sole prop. Files on your Schedule C, all that net income comes down to you personally. You pay Social Security, Medicare tax on that net income. Plus, all that information is reported on your personal income tax return. So if you can convert that, you can actually convert that LLC to a single member S corporation. Then, yes, there's a little bit more work, but then you can dictate how much money is paid through salary and how much money is paid through a distribution and just income tax. If we do a salary, that's what's going to be taxed for Social Security and Medicare purposes. So that would be, the same thing as the bottom line of the Schedule C. And potentially you're going to save 15% of whatever that bottom line is, or at least half of that bottom line at minimum. So you take $100,000 net income, it's 15 grand that you're paying extra in Social Security Medicare tax. We can very easily cut that in half and save you $7,500 just by making that change to an S Corp.
And then talk about some of let's follow that through on how they pay themselves. Because a lot of folks, should they do actually a small W-2 salary, which I know, we talk a lot about that. I think some just kind of take it as distributions as they need. How can they structure, again, to the financial infrastructure? How do they structure that? Give them some real direction.
Well, one of the things we want to consider is what we have to consider what they're doing for the company. So we have to look at the job description, and we want to look at kind of the age of our client, because looking at that is, we don't want to miss out on Social Security. So you don't want to just not have any kind of earned income or any kind of Social Security, because obviously that's a part of the retirement or a part of the revenue that you can collect later on in life, and you don't want to leave that on the table. But again, we don't want to pay 100% and everything we have to that, because we've got opportunities where we can take that extra money and invest it in how we want to versus how the government is investing it. But there are a couple of things that with the S Corp corporation, the IRS has required us to pay a payroll tax. Mm-hmm. And do a salary, because you can basically consider consider you as an owner of the company and then also as an employee of the company. The minimum I can go into, it's a super long description, but the minimum you really want to pay yourself is about $7,000 a year, assuming you're making money on the company. Now, if you're running at a loss with the company, not taking any other cash out, that number can change. But if you're pulling money out, you want to at least do a $7,000 payroll, and potentially a little bit more depending on what you do for the company. So that's an individual basis.
And someone asked from the Facebook group, what's the benefit of extending kind of back to the September, October? Clearly it's because you really shouldn't be paying if you have good tax strategy. You shouldn't be paying or getting a refund.
Assuming that you're not owing anything, and whether it's justified or not, when the IRS is pulling their returns to be audited, they start that fairly early in the process. And some of it is computerized, but by the time they get to that, there's a feeling out there that by October 15th, they've already selected everybody. So you have a slightly less chance of being audited. I don't know if we can actually ever prove that or not prove that. And then also, one of the things, typically, if you are investing in some of these alternative investments, you're not going to get your information to file a correct return until that date anyway.
Explain that a little bit more. So I don't think people realize, I back up from the alternative investing strategies, getting those K1s and those delays. So what happens is you invest into an apartment complex fund, and that K1 gets issued. That K1 is typically going to be issued because they've got to go through their accounting records. The initial date would be March 15th, but they're probably going to extend that until closer to September. So you need to have that long date and that extension to be able to file that correctly or be able to file that accurately with that K1. All right, we'll go back to some questions. What are the thoughts on cost segregation on real estate, especially for real estate sold this year? Not sure what cost segregation is.
Cost segregation. So basically, when you purchase a real estate asset, especially a commercial building, a larger asset, you can take those costs. You have a study done, and it takes the purchase price and it allocates it between different systems. So it allocates it between the building, it allocates it between maybe the HVAC, the electrical, the plumbing, all these different systems. And then these different systems are depreciated at a faster or slower rate. So if you are looking for a faster depreciation, so some kind of tax deduction, if you will, then you can run through a cost segregation study, take a larger depreciation because a lot of these systems depreciate faster than the building itself. As a commercial property, the building, you're going to depreciate that at 39 years, which is a really long time. And so the only other kind of factor you have to figure that is if you're going to sell this or flip this property, then you're going to have to recapture that depreciation that you took early on. So then you want to consider potentially doing a 1031 exchange with it. So there are some factors when you don't want to necessarily have to recapture all of that depreciation. because it has to be recaptured at a higher rate than a capital gain would be.
And so as you look at alternative investing, there are some, obviously, like gas and oil, which is now completely capped wells, but it still has some of the best depreciation schedules. So as we're working with this group on creating their money rules, and they're looking, right, I've heard my greatest mentor say, there's two problems in life: too much money and then not enough money. So we're dealing with when you have too much money and your tax burden is high, obviously how you invest can reduce that. Talk a little bit about other strategies, and then specifically what kind of assets that can work to reduce some of that tax burden.
There's two that are pretty prominent that you've got. I mean, obviously the real estate that we talked about, and especially if you have something that you can do the cost segregation on, you get a depreciation deduction. So you invest $100,000, comes back, and you get maybe 50% of that can come back in a depreciation deduction, offsetting, and then that gets to offset some of your other income. Now, for oil and gas has kind of a special thing called an IDC, or intangible drilling cost. It's basically the cost that it took the operator to come up to get that well in the ground and all the operations up to that point. Now, when you invest money, and depending on the operator, but roughly it's about 75% of your investment would come back to you in this IDC, or intangible drilling cost, that you get to deduct off of your ordinary income. Now, the difference between like the real estate and the oil and gas, the real estate can be limited based off of your income if you're not a real estate professional. So you have to be aware of what kind of limitations, and you might have some limitations there. Whereas the oil and gas, that's not going to be limited, because they've got a special little section in the tax code that allows you to still deduct that. So when you're looking at these deductions, if you're in a higher tax bracket, I mean, you've got to consider that as far as even if you're not, they might not be necessarily cash flowing or putting cash back in. You've got to look at that as far as a return, calculating that part of the return on your investment, because that can be substantial.
So give an example of what's substantial. Maybe if somebody had a $50,000 tax burden, $40,000, kind of walk through an example of that. And then also speak to, like, what do you do now? I mean, you and I have talked about it. When gas and oil is, the prices are on the floor. Fields are being given away. You can barely, everyone's selling right now. So do you even take a risk at that?
So taking a risk of that really depends on your risk tolerance and what kind of investment you want to, because there are still people that are going to, just because it's not being pumped out doesn't necessarily mean that the oil is gone. It's still in the ground. It's just not cost effective to pull it out. So you could have operators that are just buying up a ton of different wells. And if you have that, risk tolerance to be able to sustain that, then it might not be a bad idea. But again, it is not going to be for everyone, because you're not going to get cash out of it for a while. So if you look back to the tax burden, if you have, let's say you're in the 35% tax bracket, you would be able to save, if you do, let's say you put $100,000 into this type of an investment, you would basically, the direct relationship would be, of that $75,000, 35% of that, roughly $30,000 would be a deduction, a direct tax savings for you. So it can be a very significant tax savings on your bill, depending on what level of income tax. Now, if you're in the 10% tax bracket, obviously that tax savings is not going to be as big, versus the higher levels.
So what do you think is going to happen with gas and oil? Opinion question.
Yeah,
it's rough right now.
It's really interesting, because I had a discussion earlier today about gas and oil. I mean, gas and oil is if you've studied economics, it's a true supply and demand commodity. So when the supply is there, they turn it on, and when the supply is not, it turns off. So they have complete control, and it's quick whether they turn it off or on. We are not going to be all electric cars. We're always going to need petroleum products.
Yep.
So, and it's not just the fueling of the vehicles. If you think about what products take petroleum, the clothes you wear, anything with any kind of elastic clothes, that's all petroleum. Pretty much everything that has plastic in it is a petroleum product. And that's not just the vehicles that we're looking at. It is everything we touch. There's not a single thing that you touch today that does not have petroleum in it. So yes, when and where, how fast that recovers, I wish I knew, because then, I'd obviously be a lot richer than I am. But I think it is going to recover, but it's just when.
Mm-hmm. I would agree. I'm going to move to Facebook group. So Maureen from Facebook says, do you know yet how forgiven SBA PPP loans will be treated in an S Corp tax return?
Yes. So currently, and subject to, the little caveat, subject to change, and if Congress changes. So originally, this whole PPP thing, they had told they didn't want it included in gross revenue. Okay, perfect. So it's not included in gross revenue, but what happens is on the amounts that you get forgiven. So let's say you got a $100,000 PPP loan, you spent that correctly on payroll, you paid the payroll, you won't get to deduct that expense on payroll. So yes, it has the exact same effect and will be taxable on your bottom line. So that wasn't necessarily the intention of Congress, but that's the way the law was written, and the interpretation from the IRS is the way it's going to happen currently. Unless they change it, it will be taxed to you on the bottom line.
Okay. When depositing a large sum of cash, is it best to set up a revocable trust with an account set up under the trust? When you're depositing from where? That's interesting. So it's a Facebook question.
When you're depositing cash.
A large amount of cash is what the question is. Could be in the MJ business. That's still going to be bank related, not trust related.
Yeah, no, it's the relationship with the banker is going to be key to that one. And then whether it's the amount of paperwork and how often you would deposit that money, that is kind of a concern. So there, again, it's a Patriot Law Act or law that they're really trying to come up with to track fraudulent monies being transferred is what they're trying to do.
Mm-hmm. And so when and why would you transition to a C Corp?
I don't know if I'd ever actually, quote unquote, transition to a C Corp, but adding a C Corp to your repertoire of entities can be a very useful, beneficial tool, because you can set up a C Corp, but obviously with the current tax law, the C Corp is taxed on its own. It's not part of your income, especially if you're in the higher income bracket. You can utilize a C Corp, and we can keep it at a 21% tax rate. I would guess that this is probably not going to last more than a couple of years. But I think what's going to initially happen is they'll do the brackets again, but there'll be only a couple brackets the next time that comes around. You might be at a 21% rate, but then, some of it might be at a higher rate. Previously, we had a lower 15% rate, which was kind of beneficial because we could tax, 50 grand at a low rate versus the larger amounts. Use it as a tool, not necessarily transition your operating company over to it, but, using it as a tool to level some of the income.
And so what would be some of the uses of a C Corp?
Some of the types of C Corps you can have, whether it could be maybe your C Corp holds intellectual property or license out that property to other operating companies. It could be a management company, a consulting company, and, you can pretty much put it in any state. So it's kind of one of the considerations. You look at the states that maybe have a little better tax treatment than one that you're possibly currently in. And, establishing a location for the company there and running it out of that state versus out of your home state. And so, part of the thing too is especially if you put maybe some intellectual property, that's can be a value or an asset that you have. And by moving the entity to a different state, kind of out of where you live, it makes it a little bit more difficult for people to find you or find it. And again, it makes you a smaller target. That's the whole kind of idea. Is our information is it's everywhere on the internet, and the more private you can make that, the better it's going to be. And by separating the IP, putting it in a corporation, obviously never name a corporation your same name, do it kind of differently so you can have that privacy. Privacy is going to become really key.
And so When do you start that divide? Like right now, a lot of our clients, especially the new ones that just came out of our event, we're also in conversations with Scott or, just joining table. So like you said, they'll have an LLC or an S Corp as their operating company. Is there a revenue? Because a lot of times that's the question, is at what point, because I don't know that it's about revenue. I think it's more about asset protection. But when would you add on that, say, LLC and C Corp or S Corp and C Corp?
Favorite answer, it depends.
I know. I love that.
And it depends on several factors. One, the complexity and the level of education and knowledge that the client has. If they can handle it, you want to put it on. I mean, I would say put it on as fast as possible, get it all set up, get it set up initially. However, that's not necessarily realistic because a lot of people can't understand that and don't understand that and get confused. And then they flounder a bit and don't move. And it's worse not to move than it is to not have that set up, in my opinion. Mm-hmm. So as level of importance, one, I mean, it's the operating entity is the most important entity to set up first. Then I would probably, especially a lot of people, invest in real estate. So I'd say the real estate company would be next. Again, this is, we're talking about asset protection as well with this. And then probably the third priority would be to setting up the C Corp. And doing those for a lot of people, it works better in phases where they phase into that. Set one, set the next one, do the next one. But there are a substantial number of people that understand it. They get it. They go, I understand. I mean, but no, setting them up all at once. You will need them set up eventually, but doing it all at once can be just a little bit overwhelming.
And so talk about some of the deductions. And maybe we use like an S or an LLC versus a C. Like as folks start, just starting, how do they get their computer? How do they do their home office? How do they start moving those deductions, those expenses really as deductions inside the company and start making those decisions? Most people don't move enough fast enough.
I would say probably one of the biggest questions is, do you have a list of deductions of things I can deduct? And there is actually not a list of deductible items. There are some things that you can't deduct, but the rules are it has to be ordinary and necessary. And it has the primary purpose of that expense has to be for the production of income for the company.
See how creative that is?
There you go. It's an education process where the client or the person who's just starting this business really needs to change their mindset. Instead of saying, oh, this is not deductible, saying, okay, what do I need to do to make this deductible? How do I have to treat this expense to make it deductible? And, there's some documentation, there's some, thinking. It's really about your mindset and how you're thinking about it to be able to deduct it. So that's kind of, if you have the right process, you can pretty much deduct most things.
Yep. So talk about, because we talk a lot about, going on business trips versus vacation. Give some insight. Let's just use real estate. That's an easy one. What makes the business trip deductible for someone's real estate company? What do they have to do?
So, one, you have to document what you're doing. You have to document why it's a business trip. And so if you're going out there and looking at some properties or looking at the market area, you need to say to have records of what you went and saw. You need to kind of keep just a general narrative of that trip. Just because one of the days, perhaps you saw some family members or you saw somebody else, you just need to be able to document that the main reason why you went out there was to look at the real estate, not necessarily to go see the family.
But they could see the family and see some real estate.
But again, the primary purpose of that expense is to go out there to see real estate. When you're doing events, people could come to Lake Tahoe and go to one of your events and deduct it.
Yep.
Just because maybe they went skiing beside the path, one of the days, that doesn't necessarily negate the whole expense or the whole trip being non-deductible, because the primary purpose for that trip was to come out to go to the big table and to theirs. It's kind of a simplified version, but again, it's how you think about that trip. And again, you do need to keep some kind of documentation. I'd keep the list from the real estate agent or whoever you went and saw, or if it's a apartment company, just keep a narrative, and that's really what you need to document.
Awesome.
Thanks for listening to the Real Money Talks podcast. Your host has been Laurel Langmeyer, author of 5 New York Times bestsellers, money expert on Dr. Phil, CNN, CNBC, The Street TV, Fox News, and The View. Want to learn more about off-Wall Street investing, tax strategies, and multi-million-dollar business strategies? Visit liveoutloud.com/podcast for past episodes, show notes, and resources. For some special wealth-building gifts only for Loral's podcast listeners, visit liveoutloud.com/podcast gifts. Do you have a burning question for Loral? Visit askloral.com to submit your question, and it may just be covered on a podcast episode. So stay tuned and be sure to subscribe to get new episodes every week.